Our next topic centers around charitable strategies. Those who are charitably inclined, there's lots of opportunity to save on your federal taxes. Taking a quick step back. So the Tax Cuts and Jobs Act of 2017, or TCJ for short, overhauled the prior tax system. The objective was simplification for the average tax filer, or that was one of the objectives. So TCJ eliminated personal tax exemptions, it lowered personal tax brackets, and it removed and or limited many personal deductions, and it greatly increased the standard deduction. After TCJ, many filers who were itemizing their personal deductions switched over to taking the standard deduction. But good to note, charitable deductions did not get removed. However, going back to that standard deduction being much higher, roughly, they index it for inflation. It's roughly about $30,000 for married filing jointly and about $15,000 for single filers. It makes it so it takes much more donations to reach that itemizing deductions threshold. So we saw a couple strategies employed, so people could still enjoy those charitable deductions. One strategy, it's not like the official name, but we hear a lot of people refer to it as what's called bunching. So instead of doing donations each year, taxpayers alternate years. On alternate years, they do a double-sized donation. Those donations are large enough for them to itemize that year. And then the other years, they go back to taking the standard deduction, kind of like a either-or process. So taking it a step further, a more advanced version of, again, I don't know if it's the official name, bunching, can be done through use of what's called a donor advised fund, commonly abbreviated DAF, or simply called a DAF. I'll probably call the DAF out of habit for the rest of so. So DAFs are managed by sponsoring organizations that qualify as recipients of charitable donations, and hence, by putting money to a DAF, it's still eligible for the federal charitable deduction. The DAF holds those funds until you are ready for them to go to your chosen charity. So let's walk through a quick example. Let's say you have $30,000 that you want to give to your favorite charitable organization. You just don't want to give it all this year. Maybe you had it in your mind you really wanted to give them closer to like $10,000 a year. However, if you simply held that $30,000 in your account and divvied out $10,000 each year, you'd only get $10,000 towards your charitable federal deduction goal each year. And this may not be enough to itemize your deductions, but put that same $30,000 in a donor advised fund, you get that entire charitable deduction that same year. A DAF is kind of like a water faucet where you can control how quickly or slowly the funds are coming out of it. You essentially advise when that DAF contributes to your favorite charity. So technically, you don't even have to know who your ultimate end recipient is when you contribute to the DAF. You can decide the who, when, and where at a later time. All will get in that tax deduction up front. Another benefit is those funds in the DAF appreciate tax-free depending on how they're held within the DAF. So going back to our example, so maybe instead of giving your favorite charity $30,000 over 3 years, maybe you're able to give $33,000 because of the investments it was in. So just, DAFs are just a really, really good consideration in high income years when you need as much deductions as possible, or in years when you're doing some Roth conversions, which Susan's actually going to touch on later. So one final note on DAFs, they can be used as an estate planning tool. I'll be honest, we're not going to discuss estate planning today. It's a topic that you can go deep on. It's definitely one that we're considering covering in the future because of its robustness. So 2 other things outside of bunching and DAFs that I want to mention regarding charitable planning. First off is for those age 70 and a half and older, you can choose to gift up to, I think it was either this year or last year, is $108,000. It's indexed with inflation like a lot of things with the IRS. But you can choose to give that amount from your RMD out of your qualified retirement account to satisfy all or some of your RMD requirement. We find that like a lot of seniors who are in that position who don't necessarily need the cash, but they're underneath that mandatory RMD requirement, it's a nice way for them to give and also bring their income down. So the other last topic I want to cover on charitable planning is, and it was kind of touched a little bit earlier, you can gift highly appreciated stock in your portfolio as opposed to selling that stock and selling the cash. What this does is this actually bypasses having to realize those capital gains altogether. So if you bought a $100 stock 20 years ago and it's worth $10,000 now, it's really good stock. Instead of having to pay capital gains on $9,900 of capital gains, if you give it to your favorite charity, you don't pay any tax on it. And also, your donation is not based on your historical basis. It's based on fair market value. So a really great strategy.